Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, July 11th, 2019. In this video, I wanted to do analysis of bonds. We're going to look at various bond ETFs. Before I get into the charts, if you're not familiar with what a bond is it's an IOU essentially. If you buy an individual bond, it's a lot like a CD. For those of you that have had CDs at a bank, on an individual bond, you have a fixed interest rate, and at least the bonds we're talking about here. We're not talking about adjustable coupon bonds. Fixed interest rates on the individual bonds, and a finite, known maturity date. You can do short-term, long-term. You can go all the way out to 30 years on government bonds, U.S. government bonds. Some bonds are even longer than that. U.S. used to issue, I think, up to 50-year bonds, but right now, and for a while, it's been 30 years. So we'll look at that. We'll look at long-term, short-term bonds. Now keep in mind, when you buy the bonds in an ETF is a lot like a mutual fund. So TLT, for example, which holds 20 to 30-year Treasury bonds, is going to hold a pool of bonds. So what will happen is, unlike an individual bond, if I buy a 5-year Treasury bond, I put $100,000 in, I lock in at whatever the rate is, 2.5, I don't know. I am guaranteed, if I hold it to maturity, to get my 100,000 back. Plus, I collected 2.5% interest all along. But if I buy a short-term bond ETF, it's going to hold those bonds. There is absolutely no guarantee. In fact, the odds of me getting exactly what I put back in are slim to none. Very, very, very low chance. What that means is the value of the bonds in there in an ETF, you have a pool of bonds, and what they're doing is they're constantly rolling over, buying new bonds when the ones in there mature or don't meet their holding period anymore. Like TLT, for example, they'll drop off the shorter maturity bonds. They might buy a 30-year bond today at auction. 10 years from now, if the prospectus states that they're to hold 20+ year bonds, 20 to 30-year bonds, so 10 years from now, that bond's now dropped under the 20-year mark, they're going to sell it, and they're going to buy another 30-year bond to keep rolling. So what I'm getting at there is, in these ETFs, although they are bonds, you are not guaranteed at any point in time, not even close to being guaranteed your principal. In fact, you go into a bond fund, you can lose a substantial amount if you're in it at the wrong time. They are inherently much more stable than stocks, but as you can see, this is a 10-year weekly chart we're at right here. I'm going to grab right around where that high is. I'll put my crosshair there and show you there's a period that was about a year and a half, and TLT fell by 24%, which would have much more than offset any interest you collected over that period of time. The interest would have been nil, 3-4%, maybe over that whole term, 5-6%. Again, it dropped 24% in principal. So bonds, the takeaway from this, bonds are, especially these bond ETFs, they're swing and trend trading opportunities. Also, they are and should be a portion of most investors' portfolios for their long-term money. The old rule of thumb, in my previous life I was a financial advisor, and the old rule of thumb, it's just a general rule, is you take to find out or to determine how much of your money should be into equities versus bonds in a portfolio. You take the number 100 minus your age. So that says somebody that's 50 years old should have about half their money in stocks, half in the bonds. Then again, that's a rough model. My portfolio, my asset allocation model includes commodities, precious metal, gold as well in that piece of a pie. So I don't think anybody should be only in bonds, only in stocks. Again, commodities selectively at the right time. But again, like I said, it's a rule of thumb. Now, why is that? Well, as you get closer to retirement, let's say now you're 65 years old, and that's saying rule of thumb, no more than 35% or about a 35% allocation towards stocks, 65% into bonds. Why is that? Well, you're right around the corner. Maybe you're in retirement then. And again, those are other variables. You can't afford another 2007 to 2008 where the stock market fell over 50%. You can't afford that because you don't have the time to make it up. And in addition, you're pulling money off your portfolio once you retire. So that's where you gradually use that rule of thumb to, as you as you get older, closer to retirement, you should shift more of your money into more secure investments such as bonds, which again, you can drop, bad year if you're in long-term bonds, it can certainly go down, 20% or more, but you're not going to get wiped out. Government bonds are not going to drop 50% in a year, 60% in a year like the stock market could in a bad situation, and has, several times in the past during bear markets. So the takeaway from this video will be two things. I'm going to go over various bond funds, which may present some strategic or tactical trading opportunities here, short-term trades or trend trades, depending. And more importantly, and this is the way I view it, I recently, and I stated this, I had up until recently, going into the fourth quarter 2018, I had shifted a good portion of my long-term funds. I'm talking 401k, IRA type money, that's put away. That went into Treasury bonds, and I had some corporate bonds until, in fact, just a couple weeks ago, I sold out the last of LQD, which is a corporate bond fund ETF. And right now I'm going to make a what I believe to be a pretty solid case that, although, as I said a minute ago, it should typically make up a portion of somebody's portfolio, you may want to lighten up, especially if you're pretty top heavy on bonds right now. Let me get into the charts and I'll show you why. So we'll start here with TLT. TLT, again, is a long-term Treasury bond fund. And now longer-term bonds tend to be, or they are, more interest rate sensitive than short-term bonds, meaning for every 1% or whatever the move is up or down in interest rates, it will affect the price of the bonds more because they're locked into into the rates that they have for a long period of time. So therefore, falling rates are typically, all other things being equal, falling rates are bullish for bonds. Bond prices will go up. If you're holding a bond fund, that's what you want to see, falling interest rates, and vice versa, works the other way. Again, because if you're into a 30-year Treasury bond locked in at whatever they'll pick, say 4%, you were locked in at, and all of a sudden the 30-year bonds over the next few years go up and they're paying 5, 6, 7%. As I said before, you can hold that bond to maturity, continue to collect your, what did I say, 4% coupon interest. But if you want out early, that's the good thing about bonds. Unlike the bank, it'll penalize you on a CD if you break it early. Bonds trade liquid, so you can get out of an individual bond, sell it. But if you go to sell a 4% bond with almost 30 years left on it, and the new ones are paying 6%, guess what? I'll buy your bond from you, but I'm going to give you 96, 97 cents on the dollar, whatever that number is. The market will price that number in, because I'm going to collect lower interest payments. So where I make my money is paying you less than face value, and then I hold that bond till it comes due, and then I make up that extra, whatever that number is, 4% or whatever. So that's the gist of it. Just remember, rates go down, bond prices go up, and vice versa. So what do I see in TLT? I've covered this chart many times in the past. This is a long-term trend. We have 2011 here. We have an uptrend line, well defined, and we broke down below that long-term trend line here on TLT and bottomed here. We put in a divergent low at the time. You can see right there, divergent low, and then we broke out of here, back tested. I had a first target even before we broke out of the wedge at that 122.50 level right there. We hit that first target, came and back tested, then took out that first target, back tested, hit my next target here, which was 128.56. Way back here at the time before we even broke out of this wedge, I had stated this or I said the first of this and or this uptrend line. So what happens, we powered through the 128.56 level, we hit my uptrend line, and we've been back testing it. So this is resistance, and right now what I can show you here is a couple things that stand out. TLT is overbought. Remember, we're looking at a 10-year weekly chart, so this spans a decade. We've only been overbought before this time 1, 2, 3, 4, 5 times. Let's take a look at what happened each and every time without fail. I'm not skipping any overbought readings. You want to see what the risk reward was. This is what I talk about in the stock market. We were overbought a few weeks ago, a couple months back, and I tried right when we hit that trend line, I tried a short on TBT, which is the inverse. We were stopped out for a small 3% loss. I'll take that all day long. I may go back. I am, like I said, I'm personally short. I mentioned before going on vacation to take some ZB, which are the Treasury Bond Futures, short as a hedge to my index shorts. So, and so far we're starting to reverse off there impulsively. So that's the whole point of this video. There's some other bond funds I'm going to cover here, but you can see now we back tested for a while. And I always say that's the problem with a back test, whether you're back testing a downtrend line after a breakout or you're back testing an uptrend line from below, is that you can continue to back test for some time. And there's also no guarantee that you won't back test and then break on through there. But what you want to see is finally an impulsive rejection. So far we have a pretty solid red candle working off there. So that's pretty good. And again, I'll get to the short-term charts in a little bit later here. But again, the takeaway here is if you have treasury bonds are a decent part of your long-term money right now, especially if you're very heavy into bond funds, as I said, and I just showed you there what happened each and every time we were overbought like this without fail. So trading's all about putting the odds in your favor. Just because it happened the last, what is that, 5, 6, 7 times, maybe even go back farther in time, you'll see the same thing, doesn't guarantee it'll happen again. The problem with overbought is sometimes it can stay overbought for an extended period of time. But again, statistically speaking, the treasury bonds, to me, just like the stock market, have minimal upside from here. You know, the only benefit holding these, the interest is so low. Again, I don't think that outweighs the risk of downside. Now, what you can do if you have bonds, you can use stop loss orders. You know, maybe I'm wrong. Maybe we'll go up and continue to stay overbought. But a stop would prevent one of these situations from happening. Again, let's turn those lines off here and just measure out to try to quantify it for you. And if you have, maybe you don't own TLT, but you have in your 401k, you know, a treasury bond fund, that's an 18% drop, almost 19% off that previous divergent, I mean overbought reading right here from the time we were overbought. And again, we got a little more overbought once we crossed the 70 level down there on the RSI, but there was a 16% drop. So you get the point. Go back here. That's the previous time we were overbought from high to low, almost 24% drop. So this is why I'm doing this video. And while you may not care to short treasuries, it might save you a decent loss in your, you know, or get back in profits. By Xing, especially if you were in here, you know, as I was and caught the bulk of that run up. It's a nice move. Maybe stand aside for a while, at least lighten up. You don't have to make an all or none decision with your portfolio. Remember, if you got a 401k with several $100,000 or more, you know, you can scale back, take some off the table there in treasuries. Let's look at the daily chart here. This is TLT when I come down to the daily time frame. I'm not crazy about this uptrend line, but what I will show you here, we can maybe have a different board. These are previous trades on TLT, all those targets there. Here, I'll do this right here. There it is, clean board. This is what stands out to me. I have the divergent high right here on the daily time frame, negative divergence, and we're starting to move down. I think this is a likely target right now for TLT. You can see a fairly well-defined uptrend line, and to hit that depends, of course, where we hit it. You know, the faster we fall, the bigger the drop, but that's probably about another 1.5 to 2% before we get there. And again, as I just showed you on the weekly chart, the average drop following those overbought readings was well into the double digits. So this would just be an initial target, swing target. It might look something like this. One more thing to say about that. You might say, well, Randy, geez, you know, 1.5, 2%, it's not even worth it. Well, I always talk about beta adjusted position size. When we take something that's very volatile and aggressive or leveraged like TVIX or natural gas or something like that, I adjust my position size way down. However, on the flip side, treasuries are inherently very stable, even though there's some fluctuation, those trends that you can trade. Most investors, professional or myself, I will leverage up quite a bit. In other words, that TBT trade was a 2.0 beta adjusted position size, or at least on TLT, meaning if you usually short or go long $10,000 on an average trade in SPY, you can easily take a $20,000 position, possibly more in TLT, and you're not exposing yourself to really any more risk, because in a bad day or a bad week, TLT will only drop a fraction of what the stock market can do. So therefore, just like that beta adjusted position sizing I use limits or mitigates your losses if the trade goes against you. By increasing your position size here, you're actually enhancing your gains. So you might gain a 2% pullback. I can tell you if Treasuries drop 2% and you're trading ZB, the Treasury Bond Futures, then you're going to make probably a couple $1,000s at least. Per contract, that is. Okay, if you notice, I started out with a weekly chart, looking at the long-term 10-year weekly, making a case that TLT will most likely drop. And then we went down to a daily chart, confirming it there with the divergent high recently. And now we zoomed down to a 60-minute chart. And what you can see is a uptrend line here. We can see also a divergent high on the 60-minute chart as well. And here's some targets or support levels. This will mesh. You probably noticed in the charts I'm watching for the last week or so, I've been highlighting ZB, the Treasury Bond Futures. It's a very similar chart. You had an uptrend line, and then I'm going to get to that chart in a second. You have pretty good support here, so I would expect a reaction off that level. It's not guaranteed, but the odds favor it. And that could quite likely bring us in for a back test of the trend line, and then before 130.38ish goes. And if it goes, there's a big thin zone. What am I talking about? A thin zone. This is a thin zone. Let me turn on the volume at price histogram so you can see it a little bit better. These are very useful tools. I usually have them turned down on my chart. I can see it. I like the colors very subtle. I don't like busy charts. Too much in there, it's hard to I like to focus on price first and foremost. But when you turn on these volume price histograms, what they're telling you is that the bulk of the trades, at least from the period of time here on the chart, going back to late March, most of the trades in TLT have occurred right here. And before that, there were a lot of trades. I've covered the candlesticks, but there was a lot under here. This is a thin zone. There were trades, but they were very few. We broke out above a consolidation area, quickly moved up here, and began a new consolidation area. This is similar, comparable to a gap. A gap, you wouldn't have any trades, so you wouldn't have any volume at price histogram bars there. But a thin zone works the same way. Not a lot of trades. So when you break support, what I would expect is a relatively swift and relatively unidirectional move down to that target there, and then a bounce from that level. Okay, and here's that ZB 60-minute chart that I've been posting. These are Treasury Bond Futures. Okay, sorry, I had a brief pause there. I had to pause the video. All right, so we have a couple uptrend lines to watch. This one may come into play. I think it will. In fact, I like the fact that it comes in with price support here. So this is comparable to the scenario I just showed you on TLT. We broke this. We had minor support right here at 154, 151 right there. Went through it a little bit, but then we're down below it, coming up on trend line support. If that trend line breaks, normally if we didn't have support below, I'd say that would be a sell signal for maybe a full position. However, because there is some minor support below, just like on TLT that I just showed you, probably chances are, it's not guaranteed, but there's a good chance we get a reaction. And if we did, a pushback to back test the trend line, possibly all the way to back test that 154, 151 level, and then a move down here. So again, on ZB, because the leverage is built in already. TLT, there's not any leverage. TBT is a 2x short version, but if you trade futures, and if you do, you should already know that, and then you can check with your broker and see what the leverage factor is and everything else. So there's a potential swing trading op here, and these are ZB. You're not paying any dividends. These are just the bond futures, so it's pretty much a pure play on shorting treasury bonds. Most importantly, as I always say, support is support until and unless broken. So whereas up here, based on the fact that there's two ways that I'll short a stock, or for that matter go long a stock or any security. I will short a break of support, well-defined support level. I'll short a breakdown of a bearish technical chart pattern, or I will short a push into resistance. You don't see it here, but I showed you before we were at resistance on the longer term charts. And when you have that plus overbought conditions and a divergent high, that sometimes helps. So got in a little early, but the trade's paying out so far. I was in over here somewhere, and it's now taken out that level. So my point is, right now we're coming up on support trend line, so it's not the most objective entry. Most objective entry would be a break of that level and or a back test of these levels, or of course another sell signal would come on a solid break below that 153-ish level there. And again, that'd be a pretty thin zone down to about that 150-ish level there and the uptrend line. And again, just looping back to that weekly chart. So, you know, I showed those levels on the 60-minute chart. Those are for near-term active traders levels. But when I look at this, I don't see really much of any support until we come back to that 128.56 level and or up trend line right there, which is about what I showed you before, I think, on the daily or 60-minute chart. So that would be an initial target, probably get a bounce right there. You know, good place to maybe cover a position. But if it breaks, you know, then we can come down quite a bit more. Let's look at, before we get off long-term treasuries, I'm spending more time on this than anything else. I'll go through the rest of the charts pretty quickly. This is TYX. This is TLT in reverse. What this chart shows you, TYX is the 30-year Treasury bond yield. So these are rates. Again, so when this is going down, TLT is going up. It is the rates pretty much that TLT are paying. And you can see the circles here. Same thing that I did on TLT a minute ago. I was showing you the overbought readings and what happened. This is in reverse. These are the oversold. Oversold is any reading of 30 or less, that blue line on the RSI. So we're going back a decade here. And without fail, you can see all the circles. You can do this yourself. Without fail, every time we were oversold, there was a substantial rally, a tradable rally in yields. That would be, again, a short on Treasury bonds because we're looking at the yields here. So not only that, you have the oversold reading, as I told you. That in itself it's not a timing indicator. You know, it's not the minute you hit 30, you go, you know, long or short a position. But as you can see, rarely do you stay oversold for that long before the reversal sets in. And then more importantly, you have a decent, I shouldn't say very well defined, but a decent support level. It's defined by this reaction low here. Let's see, you have a reaction low there. You have a big old gap right here. And so far a reversal off that level, about the 2.20, that's about 2.45, 2.46 level on the yield. There's that wedge pattern in reverse. And you know, like I said, an extended move. So there's more evidence that you know, we'll probably get a bounce here, a bounce in yields, that is. Now, what might cause that? Let's just talk fundamentals for a second, because everything we've done up to now is technical analysis, looking at the charts. Two things that will likely or could or would drive Treasury yields up and bond prices down. Number one is, we all know, you know, the Powell came out on full-blown dovish mode yesterday. It is baked in the cake. We are going to see at least another rate cut, another quarter point, and based on what he said, quite likely more. There is a, you know, one of the schools of thought out there right now is that the recent turndown in the economy, which he's basing, you know, his dovishness on, may be just an aberration. And so if he's already made one rate cut, if he continues to cut rates and all of a sudden the economy just picks back up, you're going to see you know, the stock market should do very well, and you're going to see the flight to safety bid come out of bonds. Remember, bonds go up for a couple reasons. They go up when rates are falling, and they go up, Treasury bonds do, when there's nervousness in the market. Institutions will run into Treasury bonds. So if the stock market is looking good, people aren't worried, institutions aren't worried, they're going to sell Treasuries. We've had a big rally because of that recently. Treasuries, you know, the worries in the stock market. The other thing, too, is economic growth expectations. Treasury bonds, especially long-term bonds, Powell does not control this. He doesn't even come close to controlling this rate. He controls the federal funds rate, the overnight rate that banks can lend or borrow from the Fed directly, lend to each other or borrow from the Fed. That's Fed funds, the discount rate. Long-term rates are strictly controlled by supply and demand market forces. The governments can try to manipulate them by buying a lot of bonds or selling more on the market, but ultimately market participants will control where the long-term bonds are going, and that is based on economic growth expectations. So what I'm getting at, if the stock market heats up here because he's cut rates and let's say the economy's not falling off a cliff, then you would expect long-term rates to go up in expectation of a strengthening economy. And if that happens, TLT, which again is an inverse of this, will go down. So those are the two fundamental variables that may come into play here if you're wondering how and why bonds might drop from here. Okay, enough time spent on long-term Treasury bonds. Time permitting, I'll get to the short-term bonds in a second, but you get more bang for your buck trading longer-term bonds because, again, they're more interest rate sensitive. There's more movement there than the shorter-term bonds. However, there's a very good chance, almost a near certainty, that a good percentage of people listening to me right now have also corporate bonds in their 401k. In fact, some 401ks don't even have pure Treasury bond funds. They just have bond funds that will hold corporates and treasuries. So this is the most liquid and popularly traded ETF for investment grade corporate bonds. Again, those that are AAA rated down to the BBB, which is the minimum rating. So the bulk of the bonds out there, corporate bonds, are represented by this ETF here. And this is a 10-year weekly chart, and I think it speaks for itself. Charts are very clear to me right now. This level up here, I have a resistance zone, more like a zone right here than a hard number, about 120, call it about 124 to 124.50. And although we stopped a little shy here, again, we're going back a decade, you can see that without fail, every time LQD has made it to this level, it has corrected and gone back down to the bottom of this support zone here without fail. So what you're looking at is just a big trading range. This is in the wake of the financial crisis back in 2008. And so this is the trend. You're trying to trade channels. You can do this on a stock just as well. You find a price channel and there's your trade. You go long. It's very objective to go short at the top, long at the bottom. Simple wash, rinse, repeat stuff. Is there any guarantees that it'll go back down or even all the way to the bottom? Absolutely not. But the thing about investing or trading, it's very objective. If you short that's been the pattern with a stop not too far above. It's if you're stopped out because they break out of this range, I can tell you it is very, very slim chance that bonds are going to break out to the upside. If this happened, it would mean rates were going a lot lower. We're near the floor on interest rates. I'm sure if I don't say this, I'll get the comment, well, Randy, we can go to negative rates like a lot of European countries. No, that's you're pushing down on something that there's very, very minimal downside. If we were to go to negative rates here, and we're seeing this over there, what happens? Money will just come out of the banks. Negative rates mean you put your money in the bank, and instead of earning interest or no interest at all, you're actually paying the bank. They're deducting money out of your account. And I promise you at that point, Bitcoin, gold, everything else will go crazy. People aren't going to take that. So in other words, is it possible? Yeah, but we're talking negative 0.1, negative 0.2. So my point being there's very minimal downside. So the risk, in bonds from here is not a breakout of this range to the upside. It's a breakout to the downside, at least again a move down here. So you can see a few lines. If you want to short LQD, you are going to be responsible for the dividend, and if you're shorting bonds, you can do be more of a trend trade. Well, here's an uptrend line that'll probably come into play right there. So there's, just like treasuries, I see minimal downside before some support, kickback rally, but ultimately I see that level going, and here's a downtrend line that may come into play. But ultimately we may go down here to this price channel. Now, this is important too, to talk about fundamentals real quickly on LQD. I already talked about treasuries. Treasuries, for the most part, don't have investment risk because they're issued by the U.S. government. The U.S. government, even if our finances have been going down, or deficits are ballooning, but guess what? We're always going to make good on our treasuries. If not, they'll just print more money to do so. So the government, U.S. government, will always pay off its treasuries. However, this market here, you have a lot of risk because the bulk or a very large part of the issuance in recent years, right here, has been on the very low end of the credit spectrum. A lot of the investment grade bonds that have been issued are triple B. If and when the economy can, or let's say it continues, it's already started to turn down. That's why Powell's being so dovish. What you will see is a lot of bonds get knocked down from triple B to below triple B rated. So big deal, right? No, it is a big deal because most mutual funds, as well as many pension plans, institutional programs, by prospectus, if they have, let's say you have a corporate bond ETF that says investment grades, just like this ETF here or a mutual fund, it says they have to hold investment grade bonds. Well, what happens when you have a 20, 30% or whatever the number is, even 10% of those bonds in there that were triple B get downgraded, they have to sell them. And that can trigger, and I've read about this and I believe it will happen at some point, a mass exodus out of bonds. And so if you see economic conditions continue to deteriorate, again, it might be a vicious cycle with selling in these bonds, and that will put pressure, and that would cause a big drop in corporate bonds regardless of what rates are doing. That would, I think, override anything going on with interest rates. Again, if we see the economic conditions start to deteriorate and a lot of downgrades on the corporate bonds. So to me, the risk is very much to the downside in corporates. And again, the technicals confirm at the very most the risk reward to remaining long or going long here, corporates. Again, overbought, 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 overbought. You make the decision if you want to have a lot of corporate bonds in your 401k right now. And now that brings us to junk bonds. These are the corporate bonds that are trading below, are rated below triple B, so double B or lower. And the word nickname is junk bonds. It doesn't mean they're garbage, throw them away. It just means that those companies are at a much higher risk of defaulting. They're in a precarious financial situation. Now they do great. Junk bonds, in fact, historically trade much more closely, almost in lockstep with the stock market, with the economy, because they are much more, the price of these junk bonds are much more sensitive to economic conditions than they are interest rates. Treasuries are much more impacted almost exclusively by interest rates. On the flip side, junk bonds, because the fact that these companies, as long as the economy is chugging along, those marginally, fundamentally sound companies can continue to pay the dividends and interest on the bonds. When you hit a recession or a downturn in the economy, they start default. The default rate jumps on these and can go up quite a bit. Defaulting meaning they don't pay dividends, they stop the dividends, and if things get really bad, you may not even get some or all your principal back on those bonds. So it's also a tell. A lot of people follow this for the stock market. Junk bonds peaked back here in 2014 and have clearly been moving lower. The stock market, here we'll put it up here. Let's just put I have QQQ up. I could do SPY. This is an issue here. And again, it's one of many red flags. I've been pointing out red flags as others have for a while. Historically, you don't see this divergence between the stock market at all-time highs and junk bonds continue to move lower and making a series of lower highs. It's in a downtrend. There was a high there, high there, high there, high there. So we made this recent high in the market. Junk bonds are well off their highs from before. Now, from a technical perspective, they're also at resistance about 109 on JNK. You can see a few reactions where I placed that line. We did break out. There was a downtrend line here. We broke out and back tested, so that's bullish. Maybe they're flagging here. And again, this goes in. I don't have a crystal ball. I showed you, or at least I shared my thoughts today in the charts I'm watching update. 3 scenarios that are going to play out, and like I said, one. That the most bullish scenario is, the Fed goes ahead, they cut rates, which they already have, they continue to cut, and all of a sudden the economy comes back on track. And now that's like adding fuel to a fire. It's going to be quite bullish for the market, and if so, you'll see this little bull flag right here break out, and there might be more upside in junk bonds. So at the flip side, I can make the technical case. There's a divergent high right here on the weekly chart. They're at resistance, and maybe they come back down. So that's JNK. Let me turn off that comparison. Let's just take a look at the daily chart real quick. And there it is. So you can see right here, we had a price channel. We had a divergent high there. Again, these divergences don't always work, but much more often than not, I would say well over 90% of the time, divergences play out eventually. So you had negative divergence. You can see the first right here. And boom, that led to a sharp correction. Came back to support right there. That was nice support, about 105.65. Pushed back up, and just like the stock market, that new high was simply an extension of the existing divergences that were already in place at the time. So to me, that's not, like I say, breakouts that occur to new highs with negative divergence and overbought have a much higher rate of failing. So if you want to know where the sell signal would come, it would be on a break below that 108 level there. Again, keep in mind if you short JNK or the other high yield ETF, which is HYG, you are responsible for the dividend. So you're going to have to do better than that. I don't know what it is right now. I could look it up. I don't know, 5-6% maybe. There's HYG, same thing, divergent high. So the technicals are there that show me that you know, the risk reward. I'm actually a little more bearish on the corporate bonds than I am on HYG, to be honest, in JNK. Same story, breakout at resistance. You know, if the bullish scenario plays out, there might be more upside here. Here's another bond ETF, FALN, which is iShares Fallen Angels. These were companies that were, what was it? They were good credit quality. They fell out of favor. So they're at-risk bonds. I don't know if they're all junk bonds. I have to revisit that. But pretty bearish candle today in a divergent high, and there's a trend line right there. So here's another trading op if you want to short this, and I think you would outdo it. You'd have to, again, take a look, see what the dividend is. You'll have to look at your time frame. You don't want to short it right before the dividends due, although you could. That usually, when something goes ex-dividend, it should drop by the amount of the dividend that's about to be paid. But there's a little wedge pattern, and where does it go? Potentially, I think first target would be down here somewhere around those previous two reaction lows, and that'd be a, you know, decent drop, about 3%. But again, I'm doing this video as much as to, you know, give a heads up that if you have a large portion of your money in bonds, which have been the place to be since last quarter, and that's the other thing, as I said, very rare to see both stocks and bonds rallying, especially treasuries in lockstep. That's not very common, and typically a mean reversion follows, meaning one or the other will reverse. Here's an idea if you want a short high yield. Now I couldn't find, and if anybody knows of it, a short ETF for corporate bonds, that would be great. You know, as I mentioned before, TBT, if you want to short long-term treasuries, you go TBT. It's 2-time leverage. There's some targets. I've shared this recently in the past, this chart. T1's that trend line, T2, T3, you can see that there. And then I just had SJB, which is, it shorts high yield bonds, the junk bonds like JNK and HYG. I haven't listed any targets here yet, but I think it's, I showed you a minute ago those reactions right there. So that'd be the first target level there. So that's another potential trade-off. So again, if anybody knows of any ETFs that short corporate bonds, investment grade corporates, I'd appreciate if you'd share it, maybe post it under this in the comments section below this post. Okay, sorry, I had to pause there, had to pause the video for a phone call. One more, couple more charts, long video. But again, I wanted to kind of be all inclusive here because there are not just, you know, it's not just one type of bond out there. As far as governments, you might wonder too, you can trade the IEF, which is only the 7 to 10 year bond. These are intermediate term government bonds, so they don't have they're not as rate sensitive. So therefore, you know, you can also maybe take a little bit larger position size than TBT or TLT. These were previous targets I had back, I guess, here when we put in this divergent low, T1, T2. You can see we've exceeded my final target back then, 107.90, which was on this line at 108.28. Overshot it, but right now we have a nice rising wedge pattern, which recently broke down and back tested. You could see a breakdown, back test, and we're moving lower. So I don't see much support, if any, until you have a gap right here above that 108 something, we'll call it 108.50, and then below that you have a nice trend line. So I think I have a pretty high degree of confidence that IEF comes back into about that level at minimum. And of course, if it were to break that, probably get a reaction first, then there could be more downside. But right now, let's just say those are my near-term targets. And I could get into SHY, which is a very short term. But again, when you go to these short-term bonds, the moves are a lot smaller, and there's just not a lot of meat on the bone. So it's probably better to be in these long when you want long exposure. TLT, the long bonds and all that, you can short, especially, again, as I said, using futures, and get more bang for your buck if you leverage up there if you decide to short. We'll wrap it up here. This has been Randy Finney with right side of the chart. All right, long video, guys. Exhausted here. Hope you found it useful. Have a great day.